So welcome to the Mailbox Money Show. I am Bronson Hill. I am really excited for this episode with Mathew Owens. Mathew is just an amazing guy who really is doing a lot of different things within the real estate space. He is a flipper. He's got 50 flips going right now or at one time. He does, lending, just some really unique lending stuff that he does, private lending. He also does multifamily. He does a lot of different things. And one thing that's really important as a passive investor or as an active investor, that you pay attention to what's happening in the market and you're able to make changes as they come, as you see opportunity. So he's the guy who's just been phenomenal at doing this. And so we're just going to have him on here, ask him some questions, get to know him a bit. So Mathew, welcome to the show. How are you doing today?
Pretty good, man. And yourself?
I'm doing well. And a little bit more about you, Mathew. I love that, we both are co-leaders of a Phoebe Pasadena, or a Phoebe group. You're in another part of Southern California, but we lead local meetups. And so we've done a number of interviews like this before, which has been great. But no, I'm doing well. So anyway, really excited to have you here. We're going to jump in and just, why don't you give us a little bit of background about yourself and kind of how you got into multifamily, and just kind of take us from, kind of that transition there.
Okay. Awesome. So I'm a CPA. I quit my CPA firm. I got my degree in economics and emphasis in accounting, and went and got my CPA license, and just couldn't do taxes and audit anymore. It was the most boring thing on the planet and needed something else. And, I started doing real estate, took some courses in real estate and things like that. And, spent the money, I'll call it, on those courses. And then I quit my CPA firm job in 2006 to go into real estate full time. So, I was a real estate genius for about a year and a half before I got punched in the teeth and lost everything, of course. So I thought I was dope and had a 790 credit score and was like, I'm already flipping. I just quit my job. And then, of course, bam, and knocked out, and I'm like, oh, I guess I'm not that dope. But at the end of the day, since then, we've, I kept with it. It's a matter of standing up after you get punched in the face, and you will get punched in the face by a ton of different things that you can't even imagine. And it's a matter of how you take that punch. And if you can go through and move forward and, and push forward and not give up, because you're going to have those ups and downs. And so I've taken those punches multiple times, not knockout punches, but, except for that one time, and you, as my success is driven primarily by that. And we've done now over 1,000 flips. And so, we know, we can, how to lose money on properties in certain cases, and how to make it back, and different strategies to squeeze money out of deals. And we do about 5 to 10 a month now. We also do a lot of value add multifamilies, mostly big construction projects, like full renovation projects, top to bottom, complete gut job type stuff, because I know I can add significant value there. From one perspective, there's an increase in risk because you're dealing with a large construction project. You have to rely on your contractors, have backups, make sure that you are funding them correctly and they don't steal your money, and right. Then on the other side, though, it actually decreases your risk because you're going to be able to get into these things for much cheaper to value of that, and really add that value on the multifamily side. So that's a lot of what I focused on, is the, I'll say 10 to 50 unit type of full value add type projects. And then passively, I invest in a lot of outside syndicated multifamily deals and things like that are brought to me by other operators, in which case you still got to do your homework on that, right? So Those operators and everything else. But we do a lot of that. And then we have about 25 million lent out to flippers in different markets of the country. And we get a lot of deal flow from all of our relationships in these different markets as well, and do a lot of joint venture flips and holds with investors where, we found a niche where people don't have all the capital for their deals. And so we'll go through and put up 100% of the money on the deal, even on a buy and hold project or a multifamily. And then we'll hold it long-term for cash flow and do a split after a preferred return. So we do those types of structures, and, we take title because we're not going to put up 100% of the money on the deal without getting title,
right?
And so that's in just my real estate experience. I have also a wife and 2 kids, a 6-year-old and a 3-year-old, and they keep me wanting to retire now. I'm not, I'd
Yeah.
say I'm not as hungry anymore. I just want to systematize and do nothing, that's
which
my goal.
which really is amazing. You mentioned about 3 or 4 things that you're doing. You've got the flipping, you've got the multifamily, you've got the private lending. You also have where you partner with funding some of these multifamily deals. And you kind of what you mentioned this in the beginning when you kind of got punched in the teeth there when things didn't go right. And there's that quote by Mike Tyson that everyone's got a great plan until they get punched in the mouth, right? And so,
I love
but
that quote.
the thing that you did though, Matthew, is you found a way, and you're still doing this, a way to pivot into things that you found to be really helpful. And I think for a lot of investors, whether you're passive or you're active, just that ability to pivot and the ability to learn is huge, because nothing is wasted if we learn from it. So we all have deals, whether actively or passively, where they didn't go exactly according to plan, or maybe they did, but we still learned a lot. I was a part of a deal where this is happening a lot, where maybe a deal doesn't perform quite as you expected, but because the market's going crazy, it's like it comes back and you're like, oh, that was great, so you end up outperforming your projections or something, or it outperforms. But can you talk a little bit, kind of like, I guess 50 flips, you're doing the lending, you're doing these different things, and you're trying to slow down. So how do you? I imagine there's some team involved with that, but like, how do you have like AI robots at your house just like doing all this stuff, or traveling for you, or what do you do to make all this happen?
So I used to travel a lot more to these markets, and I live in Southern California, even though I'm trying to find a way out for taxes and everything else, of course. But at the end of the day, in the beginning, when we started flipping out of state, and so we learned how people steal from us, and what mistakes we make, and what team members to have with secondary team members that have proper segregation of duties, back to my CPA days, and dealing with separation of the right duties, like having an outside inspector come in, an outside JV partner come in and take a look at projects versus the contractor, and doing those quality control checks where we go get inspections on every single property beforehand, and then we do it afterwards as well, and we do side-by-side pictures of everything in the report showing it's done. We go through and get full after pictures of the projects. We go get the whole list of every major system in that property with the estimated useful life of that asset. And then we have separate people coming in to help with a project, to be able to monitor and manage that project, right? Don't get me wrong, I still need more project managers, because I step in when there's problems. And as you know, in real estate, there's always problems. That's how we make money, is solving these problems, right? And so being able to go through and analyze the situation, and being able to give proper guidance of what to do, what are the steps to do to fix that problem, is key for me. And I'm still figuring out how to step out of that part of the role, because it's hard when you have that much experience of getting hit over 1,000 deals now, that we've encountered so many problems that now it's just kind of like second nature. Okay, what's the next thing we do? Oh, that costs $5,000. Oh, that costs 10 grand. What do we do next to fix it so it doesn't happen? Emotionally, let it roll off you and move forward, So
Yeah.
at the end of the day, it comes down to having the proper people in place. You have project managers, accounting people. You have, these got to be trustworthy, really key people that know what they're doing. You have to have managers and appraisers and all that type of stuff. We have underwriters of our deals in-house and things like that now, so that I'm not underwriting these, because with 25 million of loans outstanding and 50 flips happening, you better believe we're reviewing a crazy amount of deals consistently. So I've had to develop quick analysis sheets and things like that, and tech to automate a lot of this stuff. And I'm even shifting now, because one of my main guys that works with me is in the wrong seat. He's working 50, 60 hours a week, and he's great at it, but he can automate my entire business with technology now, which is unbelievably awesome. I just get giddy when I hear about that kind of stuff.
That's huge.
So
that's huge. You mentioned a couple of things I wanted to hone in on. Really, the more longer I've been in real estate, the more I realize it is such a team sport. It's very rare that somebody goes and does everything, and you're really great at bringing together a team, really in the effort of, like you said, solving problems. And that's really how people get paid well in this industry, is to solve problems. So we have a lot of people that are passively investing or interested in passive investing. And I know you also, as you fund flips, And as you do these different, you have different ways you partner with passive investors. But what are some ways that you partner with people that are more passive to do the things that you're doing?
So I have a fund that I use. I've used multiple funds in the past for debt and equity and things like that on my projects. So if I'm in the process of potentially putting together a flip fund as well, but I've been selfish at this point and using keeping the profits for myself because I haven't needed the outside funds. And so over a period of time, you develop the relationships you need for this. And there's always a need for additional capital on projects that come up. What I've been doing is funding these first and then backfilling with a syndication on different projects. So I'll put up all the capital initially, and then if I want to go out and syndicate it with another with some outside capital sources and things like that, then I'll go through that and do that. And so I have a debt fund set up. It's a closed fund basically that I use to fund a lot of my lending business and utilize that structure for investors and pay them basically 6 to 8% quarterly, depending on the investor involved and if they're grandfathered in with me on their projects. And so I go out and I after a period of time of doing this and raising enough capital, you just don't need as much capital anymore unless you're doing larger projects that you're raising $2-3 million for, or something along those lines. A lot of the smaller projects, a lot of these fix and flips are couple $100,000, $300,000 or less on an individual flip. And I have cookie cutter money, and I have other banks and insurance companies that'll buy the debt from me as well in these cases. So I can make a spread on the cash flow on there, which is a great way to invest through these promissory note type structures. So I would say, looking at someone's portfolio, they should have a passive approach to this, where this is what I do. I put 50 grand or 100 grand into multiple projects run by different operators, different assets of the country, or different markets of the country, and different asset classes, whether it's mobile homes or self-storage or fix and flip funds or debt funds or ATM machines or multifamily or any of those projects. I look for key operators that I can invest with so I can diversify my portfolio that way. And if one of these guys goes to Mexico on me, I'm okay. If one 150,000 is gone, I'm okay, versus putting all your eggs in one basket with one investor team, which can be valuable as well. If you find a really good one, it's hard not to sometimes.
Right. No, I think that's a really good, you brought up a couple things there. Now your debt fund, you're able to get money from investors, and it just currently, obviously we're not presenting any sort of investment, but 6 to 8%. And that's you pay out on a quarterly basis, annualized, right. 6 to 8%. And then basically you can reinvest that and get a higher return on doing things. So that, there's a principle there we call it kind of an arbitrage, right? So people, they're listening. One strategy is to find cheap debt, such as refinancing a house or doing a home equity line of credit, being able to take some of that money that's at very low interest rates today, or finding a way through a business loan or other things, and being able to reinvest that. So maybe that, you can borrow it, less than 3%, 3 to 5%, whatever, and then be able to reinvest that at, 10, 15, 20% on different deals, which is a really great strategy too. So obviously we're not giving any specific advice, but that's how a lot of folks really can expand more quickly. And like for you, the debt, people that don't understand debt funds and equity funds, a debt fund is much more that you don't have the upside, but it's more of a fixed return type of thing. Mm-hmm. And equity is you do have the upside. Is that correct? So syndications are typically more, you have equity and you have upside, and then some people invest via debt in those products as well.
Right. So yeah, and that's a key component, right? The upside potential associated with owning real estate, which is what you're doing in a fund. Typically, you're owning that real estate and getting the appreciation, the tax benefits, the lending leverage associated with it, which can be hugely valuable because the passive investor is not having to qualify for that financing themselves. They're the operators doing that on their behalf, and so they're only at risk for the investment money they put in, not the debt as well, which can be personally guaranteed in a lot of cases, or come with those types of requirements or burdens. And so it can be really valuable to do that. But in that type of environment, especially on a value add project, you may not get maybe the average cash flow is 8 to 10%, or 7 to 10 or something like that, depending on the deal and where it's at and how high end or medium in that project is. But the first couple of years may not be that high a cash flow because you're doing the value add and you're getting those rents up over the period of time. You might have a higher cash flow near the end or near the middle of that term of that deal, but in the beginning, it's usually a little lower. In a debt type situation, when people are investing in debt, they're getting their set return from start to finish on a particular deal, right? So it's really a more consistent return. It doesn't come with all the benefits of depreciation, of the appreciation, maybe a little bit higher return on investment because it's a little more volatile, but has those benefits associated with it, right? So what I do, and I love this example. So I did a loan inside my self-directed 401k plan, okay, for $500,000, which was 65% of the market value of that property, okay? And so I'm in a pretty safe position. I did it at 12% in a point, and the point was every 6 months, and I needed the loan for an entire year. So I was basically making 14% on my money in that situation, right? And so on the $500,000. And so my 401k then went and borrowed $450,000 of capital from an insurance company at an 8% interest rate from them. And I had my $50,000 left in the deal, of course, for my 401k. And I gave my investor the assignment of deed of trust and the actual promissory note and things like that. So if there's a default, I'm in first loss position, right? But at the very end of the day, if something was to happen, I'd go take the property back and make sure the payments get made and, make sure I don't lose my 50,000. And now my investor's in it at 55% loan to value, a much safer position even. And on the arbitrage, I'm making 14% on the entire 500 and only paying 8 on 450. So I'm making on my $50,000 a 60% plus return on investment on that arbitrage. So these are the types of strategies and cool things that you can learn how to do if you understand leverage and understand how to leverage cheap debt. Now, what if that was from a line of credit on a house instead at 3% or 4% or something along those lines? It's really interesting what you can do, but you have to make sure you know how to protect yourself, the property and the collateral, who you're lending to, the understanding the renovation and the market value of that property, understanding all the numbers and how to make sure you hold back renovation draws and interest and things like that to protect yourself on any type of loan, understanding the paperwork and the legalities involved to make sure that you're doing it correctly when you're raising other people's money. So these are the things that you have to learn in order to be able to do a deal like that. And it's a lot more active, right? So these are the structures and strategies. It's kind of cool to deal with if you start to become creative.
Well, it's interesting too, for those listening, that was he's borrowing from the 401k. There's a lot of kind of advanced strategies going on there, some things you were mentioning, but the biggest thing to remember is that you can continue to learn new things as an investor, and you can continue to learn from people that are doing things that are a little bit, just because you've never heard of it doesn't mean it couldn't be a phenomenal thing for you. And Matthew's a guy he's willing to go do the work to find those things and figure it out. The other thing you mentioned is that obviously we have debt and we have equity, but we ask this question when we work with investors. We always ask on our questionnaire, what's more important to you, cash flow or appreciation? Because people typically that are more equity or they're more long-term, it's more about the total return over those 5 years, which usually syndicated multifamily deals like what we do, they tend to more mature in kind of a 3 to 6 year time frame versus somebody who's retired and they just need steady income. They just need to know, maybe a debt fund is a great idea, or having something more fixed rate is awesome because you just know you get that cash flow and the upside is not as important. So it's interesting. And sometimes a mix of both is good, but it also depends on people's risk tolerance, because if somebody is, in a debt type of structure, like you said, they can always they have the first line of being able to go in and take the property if something goes wrong. So it is kind of a safer position as well. What are some things, Matthew, that some of our investors are kind of new to this and they're just kind of getting the handle on it? What are some things do you think people can do to kind of educate themselves or kind of learn about some things that are out there if they're wanting to be more passive? Like, what are some suggestions that you'd have just people can educate themselves?
So the first thing that they need to understand is the legal paperwork when you're actually investing with someone else, and their operational financial statements and operational plan and the assumptions and things that they put in place there. And is that even feasible to do? So normally when you get an investment document, and I love investing passively like this because I don't have to do any of the work, and I'll take a totally different return than the 60% returns, of course, because I'm doing all the work over. I'm getting paid for my labor also. You can't really compare the two, right?
Right.
But if you're investing passively in an outside syndication, then typically what I would do is, one, you need to understand each one of those documents, those legal documents in detail, and the provisions inside those documents. And so even paying an attorney just to sit down and teach you for an hour everything about your documents is worth every penny, especially if you plan on doing this over and over and over again. Spend $1,000 or a couple $1,000 going to an attorney to have them break down any set of documents to you, and make sure that attorney really understands the typical legal and tax structures or legal structures associated with syndicated investments, because not all attorneys are created equal, and an uneducated attorney is going to scare the hell out of you, even though they shouldn't, on these types of structures. And so typically you're looking for a preferred return involved, where you get paid first on the structure. You're looking to understand, what is the front load on the deal? How much money is that operator making up front on the deal versus making money with you on the deal, right? Are they making it midterm or afterwards to align interests correctly and things like that? Now, there definitely needs to be some sort of load on the investment. There are costs that go into all the due diligence and flying out there, and legal costs and all types of stuff to get that deal done, and a lot of labor that goes into that, of course. But I'm looking at, how does the deal structured? What does the paperwork look like? And do I understand all the provisions? And what are the financial statements and financial projections look like for that deal, and why? So the more important thing is why, because why did they choose a rental increase to go up 2%, or why did they say it was going to be 5%? Why did they only use 2% for expense inflation when it should have been 3 to 5, or matching what rents were at the very least? Because you're talking about inflation typically in those types of situations. And why are they taking their expenses from the trailing 12 financials to what they are now, and what's the reasoning behind each one of those expenses? If you don't understand those types of things, then you should be asking the question, because you want to think like an operator does, and you're relying on the operator to do all the work for you on this deal and be good at it, right? And so if they're not good at it, and they can't answer your questions as to why those expenses are what they are in the first place, and why they chose those projections, maybe you're just not comfortable with that expense projection. Maybe you're saying, hey, you said it was going to go up 5% a year in your projections. What does it look like if it goes down by 10? Are we all losing our investment on this deal? Or are we at least, at the very least, break even if there's a downside in the market? What happens if our rents stay the same because we do all this value add and rents drop or something, and so we're staying where we're at? Are we at least break even on those types of deals, right? So these are the structures, and when I'm looking through these, I separate it to paperwork, the operator, their knowledge, the operational side, and the structure of those deals.
Well, yeah, I mean, you brought up a great point. It really is, I follow Warren Buffett a lot, and he just says, anything we don't understand, we don't invest in. And some of these documents are, for each deal, they're 60 to 100 pages or more sometimes. And there's a lot. And if you're not familiar with it, and there's so many different ways they can structure deals. And if you know what to look for, you kind of know what it looks like. But you're right, paying to get educated. And I love your background as a CPA, because you're used to looking at those things. And that's, say our lawyers and people and everything. But I think this is really what separates great investors from just okay investors. And in general, I love doing multifamily deals. They tend to perform fine, but it really comes down to working with great operators that really are kind of in a partnership type of mindset, that are, wanting to do this with investors for a long term. You don't always know it, but that's why referrals, that's why word of mouth, that's why reputation is huge, right? And then also just making sure that, that an investor really understands what's in the paperwork. Because if there's things in there and you don't realize it, and there's all these fees, and maybe the investment doesn't perform for certain reasons, and you have to look at that alignment of interests and just say, is this really aligned? So I love that you shared that.
And I think it's important to point out that reading the paperwork, asking the right questions of the operators, and making sure you understand these things is not an easy task, right? It's painful while you do it. I've fallen asleep multiple times reading these papers. You're like, print out 120 pages. Like, really? Am I reading all this crap for a $50,000 investment? Right. And so it's painful. And the way I get through that is I think about the end result, which is, if I learn this stuff and I know what I'm doing, I will have cash flow that will be a lot more passive, and I can actually be free and have that financial freedom by putting this diversification play in place and getting through this pain, so I can learn these strategies. Because if you can do that, the end result is truly financial freedom at the end of the day. You're going to have some losses and things like that, but these are the things that really make you more money on your money than you can get anywhere else. And no other investments really go through and provide the types of steady returns that we see in real estate long-term associated with this. Yes, you could say that about the stock market right now, but you have no control over that either, right? So
no, it is really true. And again, it feels really hard and uncomfortable in the beginning. Anything you do new or for the first time. I mean, any of us, when we were starting out in real estate or learning something new within real estate, or just going through tedious paperwork, I don't know anybody really likes to do it, but the more you do it, the easier it gets too. Because you just look for, I mean, you mentioned a few things. You're like, what are the rent escalators? What's the cap rated exit? I mean, there's certain things that you look for in a deal where you're like, oh, it's this, what's the split? When do they get paid? What's the pref? Like, these are terms that once you learn them, they actually make you wealthier, because you know how to speak the lingo and you know exactly what to look for, which is huge. Mathew, let's shift gears for a few minutes here. I want to just ask you a couple things about, I know you're a big George Gammon fan as well. We're both fans of George Gammon. We've had him on one of our monthly events as well. But talk to us a little bit about what you see as far as inflation, how that relates to investing and real estate, and kind of what are you seeing right now in relation to 40% of all the dollars in circulation were printed in the last 18 months, and how does that affect investing and what we should be doing these days?
So I think it's a very, very difficult question to answer. And I get a lot of info from George and things like that. I got to tell him at the Rebel Capitalist Live that my wife hates him because I make her watch economics videos all the time. So,
he is very entertaining though. His YouTube videos are
I love it. I love it. And she actually is paying attention now too, which is great, So, and she's like, I hate that I'm learning this stuff. It's just, she tells me, so, but,
Homework.
at the end of the day, we've seen so much of this money printing to where it's going to be difficult for it not to get a hyperinflationary, maybe not hyperinflation, but massive inflation coming and I think it's going to be very dependent on the type of commodity or the type of asset you're talking about specifically that's going to go up or down, right? So if you and I think there's some major dangers of everything crashing and burning also, because at the end of the day, what happens when there's inflation? The things that when there's money printing, there's typically multiple types of money printing. The type that actually causes inflation is when it gets into the economy and things like that, basically. And you're basically going through and saying, okay, what are the things that everybody uses all the time? And it's typically food, water, cars, housing. All of the main things that are necessary to survive are going to go up the fastest when this type of thing happens. And it depends if wages go up the same as well, and how much they go up, if people are going to get poorer as these things, as these commodity prices and food prices and water prices and everything else go up on us, right? Oil prices and everything else. And so from one standpoint, you have real estate prices that are rising with inflation, just like, and the fact that there's a massive lack of supply on the market generally for housing overall, right? And so comparatively to the demand. And now the demand starts waning when you increase interest rates because it becomes less affordable. But what are some of the other things that cause that demand and that affordability to be stuck? Food prices going up, possibly. If people are spending $2,000 more a month on food every month to live, these things aren't necessarily factored in when people are getting financing for properties either. They're not looking at your food prices, and they're looking at provable debt that's an auto, a car, or mortgage, or those types of things, when and versus your income to see what you qualify for. Could they lower interest rates further? Sure, they could. And it might actually happen because they're at this sword right now where if they increase rates, the market, crashes, because we're so highly leveraged across the board, from corporate debt to personal debt to the entire US debt. And it's just, there's no way they can go through and raise it. And if they do raise it, it's going to crash, and we're going to see a major correction potentially, or a correction enough to where you have a little bit less supply or a little less demand now matching supply, and you start to cool down a bit in those cases. And depends on how fast this inflation is going to occur also. And so it could turn into a massive deflationary environment because of the economic instability that comes with massive inflation. Like looking at Venezuela and things like that, I think it was like 10,000 or 15,000 of their currency just to get a hot dog, when it used to be like $5 or something like that, or five of their currency. And it's madness where people just, I can't even believe people can live there anymore. And so, I look at that, I look at potential of supply chain disruptions because of this inflationary environment, and because there could be, potentially war in the future and things like that could occur. I personally think, and I'm a little crazy, but I think they may be setting us up for that war to change or shift our focus from the inflation that's occurring and the negative there to something different, so they can switch in potentially a Fed coin or federal currency or something along those lines to be able to switch everybody over. Because unless everybody is financially struggling, they are not going to be able to force people onto this Fed coin or federal type digital currency. Now, it may not take hold. Who knows? I'm just listening to what they say, like Gammon does on the World Economic Forum and things like that in different ways, and trying to determine what I think about what's going to happen and the nature of what their goal is, which is more wealth for them and less for everybody else, and more control over what we buy and, those types of things, right? It's what they do, At the same time, how do we protect ourselves, right? I think having some gold and silver is important, because you end up in a situation where you need that as an insurance policy if something's to happen. Potentially having some crypto or things like that as a secondary form of income or a secondary form of money, even though I think, in my opinion, the government's just going to shut it down, but I could be wrong, on that. I'm skeptical that they're going to let a competitor in to the money space with them. I think there'll be war before that happens as well. And I think there'll be war before they come off the dollar, globally with compared to oil, trading oil on the dollar. I think there'll be war before the US allows that to occur with different countries, So we're already seeing Russia start to do it and things like that. And, China talking about it and doing that type of, adjustment to their policies over there on trading, not using the dollar as much if they can help it, so.
Right. You talked about, and and anybody's interested in more of that, George Gammon talks a lot about this stuff too, but the preparation too is long-term. If there is more inflation, being in debt is actually, especially long-term fixed debt, is a great
hugely
thing.
important.
So that's why having cash flowing assets are, our friend George says, if you have a 30-year, mortgage on a house at 3%, it really is the mortgage itself is the asset, because you basically have this debt at such a low rate And if inflation picks up significantly, which it probably will over the next 5 to 10 years, much more than it is now.
Right.
And so anyway, there's different theories on kind of what happens there. But so tell us real quick, we're going to kind of wrap this up here in a minute, but you mentioned that, as far as next steps for people, they can basically, really get into paperwork and look, try to learn these terms, hire a consultant, hire a lawyer, do stuff like that. Is there any other resources that you'd recommend, that maybe a book or some sort of app or a program that you use that might help people to kind of, that use in real estate?
So we have quick analysis sheets and things like that we can share with people if they're interested in that for analyzing any real estate deal. We have quick multifamily analysis sheets too as well. But when it comes, I really like the 10BII financial calculator for doing unique seller finance type strategies and things like that. We do a lot of seller financing to homeowners because we make a bigger profit and carry the paper and make a spread on the paper for cash flow. And so we do those types of strategies with that. I love it. I love that. Read and pay attention to what's happening in the overall economy with the taxes changing and things like that right now. I think that is going to be really important to mitigate your tax burden in the future. That's going to get you to a whole nother level when it comes to investing in and being able to invest more money. We talk about on multifamily deals all the time, cost segregation studies to front load depreciation benefits and invest smart like that, to where most of your money is coming back to you in tax benefits in year one from doing those types of structures and strategies. Use other people's money as best you can and learn these types of strategies to be able to really compound growth your investment money and your investment returns, because the faster you get to your monthly cash flow, to survive, where all of your expenses are covered, the higher and the more exponential your growth is going to be. So if you need 10 grand a month to survive and you get to 10 grand a month, all of a sudden all of your labor is going towards more cash flow and more long-term growth on your cash flow, because you're not spending it on your personal expenses anymore. So I think these strategies and learning and setting up a plan for yourself and saying, this is where I want to get to, and these are the things that I have to learn to get there, is hugely important. But as far as tools and things like that, like I said, the quick analysis sheets, the 10BII financial calculator is absolutely key to doing these things.
Yeah. Mathew, I just want to say, we're going to wrap here now, but I so appreciate you coming on. I've appreciated your friendship over the years. You're a guy who really cares for people. You really want to do what's right for them. You really want to add value. And I love how you have continually reinvented yourself and found other things to do. Like you said, when you get punched in the mouth, and the market does that, right? It'll continue to do that, but you found a way to go here, go here, go here, and you're just continually finding new opportunities, which is awesome. So what's a great way that folks can get in touch with you?
They can email us at invest@ocgproperties.com, or they can go to our website, ocgproperties.com as well.
Okay, awesome. Well, hey, I appreciate you coming on the show. It's so great to have you. Look forward to seeing you again soon.
Thanks, man.
So this was a great interview with Mathew Owens. I love that he talked about getting into paperwork, making sure you really understand what you are investing in. Because a lot of times people, we just start investing, we don't know what we're investing in. And that's really what separates good deals from bad deals. Learning the phrases such as, what's the rent growth per year? What's the cap rate at exit? There's videos that teach you about cap rate online. You can research that, but really getting into the nitty gritty on this stuff is really, really important. And then secondly, we talked a lot toward the end about macroeconomics, about what's happening with all the money printing, talking about, just some different theories of what can happen. And at the end of all of that, all of us, myself, him, George, a lot in the community really believe that real estate is a great long-term investment. There could be some short-term deflationary things that happen, particularly in single family. Multifamily is typically shielded from a lot of that depending on where you are. But if you look at the last recession, it was much less volatile as far as values and rents and things like that. So we love taking out longer term debt or having multifamily properties that will really hedge against inflation. So anyway, I hope you enjoyed this interview. I look forward to seeing you on the next one. And please reach out to Mathew and reach out to me if you have any questions. And we'll see you on the next episode.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report the single best investment strategy during and after a pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.